So Brad, your latest note coming out titled The Trump Effect. What is the Trump effect?
Trump effect is I think we've seen it all around us. We're in a period of some pretty big change. Mm-hmm. And that I think, and I think we want to really kind of hit this home is that we've had a complete change of narrative in investment markets in really overnight. So first and foremost, I think we might be a good way to frame what that Trump effect is. And the second part then is maybe a caution on that as well.
Okay.
Right? So, pre-election, we lived in a world where we had deflation, or at least a concern about deflation, where earnings were hard to come by, where the Federal Reserve Board or central banks dictated most things, and we always had monetary policy was really what things came down to. And that we were going to have slow growth and really kind of low volatility because the central bank always kind of made that go away. Seemingly overnight, we're all of a sudden starting to talk from monetary policy to fiscal policy, which for the last 10 years has been a dirty word, especially in Europe, particularly due to German influence. Now all of a sudden we're starting to talk about growth, maybe a concern about inflation. And of course, the last step on that is we lived in an era before where free trade was the be all and end all, and all of a sudden now free trade might be a bad thing in this post-world order. And the last step is that beware of volatility because we have more of it coming. Mm-hmm. So that's a lot of change overnight.
Yeah, it's like black and white almost in terms of what it's doing.
Right.
It's funny. You and I were chatting before we started here, and you explained to me because in your previous note that came out, the one called Newtonian Wisdom, which talked about the problem with trying to predict everything that's going on. Can you distinguish for me because you're framing up what the world is like today, but you're not predicting.
Right. Yeah.
So what's the difference?
Well, I think the big difference. is that Newtonian wisdom came out election day, right? And I think how many experts got that election wrong.
Right.
A, let's get the election wrong.
Yeah.
And then B, if you got the election right and Trump won, the whole world was going to fall apart and stock and bond markets were both going to collapse. Well, he won and stock and bond markets, stock markets have been on a tear, and yes, bond markets have gone through, I would call a minor correction. You read the newspaper every day, you would think there's been a massive change. So, on that very day, we published this piece about why experts get it wrong, why predicting is so difficult, and at the end of the day, that when you read textbooks on managing money, it is based very much on the construct that it's like mechanical physics. And Newtonian wisdom is that unfortunately Newton lost all his money in financial markets. And so he said, I can understand the movement of stars and planets, but I can't understand the madness of men in markets. And really, I think the notion in that is that markets are behavioral, they change, they adapt, and I think so we do not live in a world that is a closed system, which is really what your engineers deal with when they're fixing a engineering system like a conveyor belt.
Yeah.
We live in an open system where we learn and we change. So I think there is enough challenge for us to frame today and go, this is where we are today, here's how we can outcome, here's the probable outcomes that are going to happen, here's the ones we think are most likely to happen in the near term, and then how do we manage the risks around that and also take care of the opportunities around that.
And really that is your job. I mean, your job is again to build portfolios that are going to perform well for individuals with their life, but also in this open system because you don't know what the new elements that are coming in all the time. And never more so than right now.
Indeed not.
Yeah.
And I think that's really, that's one of the real refreshing things that we do is that, we openly acknowledge that we live in a very dynamic system in the world. Flip side is our clients are very dynamic. Mm-hmm. And so if you take those two elements together, I think that trying to really forecast out a long way of all the things that are going to impact that is really difficult to do.
Having said that, now you did frame again that this is a very different we've come through, I might even say an inflection point. I mean, in terms of maybe the kinds of things that are happening right now.
Right.
And you talk about the fact that, this could be the beginning of an era. Could be.
Sure.
But we actually don't know. Someone's going to call that later on when they have the benefit of hindsight.
Right.
So having said all that though, what themes are you seeing? I mean, what's emerging right now?
Right. Well, I mean, here's some of the things that we know. right? And here's some of the things that we can make decisions based on. Number one, a baton is being passed from monetary policy to fiscal policy. So that's going to have an impact, right? So I think that's I think that's the first one. So by doing that, that is going to have a potential impact on inflation. Now, when your whole portfolio was bet on that you're going to have deflation and always interest rates going down, it is reasonable for us to say with the changes that are potentially coming in the United States, and I'm going to reference United States a lot of times here because that's the driver behind these changes, right? We're talking about bringing tax money back from globally and bringing that home. That can have a big impact. We're talking about changing and dropping people's personal spending habit, which is 3/4 of the world's economy just comes from people going into their pocket and spending, right? You reduce that amount of tax that's taken from that, that has the potential to drive more growth. You start driving that more growth, all of a sudden you're going to start looking for companies that are having better earnings. Finding companies with good earnings have been really hard to come by. So there's another theme, starting to look for those earnings, particularly ones from the United States. Another theme that you want to think about is looking at it in terms of if that all this good news in the United States leads to a stronger U.S. dollar, and a stronger U.S. dollar means kind of potentially bad news for Europe, because Europe really kind of struggles in an environment because they're already struggling with this, right? And one thing that the next piece we want to think of is in emerging markets, this is difficult. And one thing we really want to point out, if you look at Chinese corporations, they have somewhere around $18 trillion in debt, in US dollar debt sitting on their balance sheets. Every time the US dollar strengthens, boy, that puts pressure on them. So I think you want to think about portfolios in very North American terms as a theme. And look, a lot of your risk management is going to come around your European exposure and your emerging markets.
Each one of those is a 2-hour conversation.
Yes.
But I was going to say, but I appreciate the outline. Having said that, though, for someone who's watching, if I was to run through the asset classes and just get your thoughts on what you see right now, and again, each one kind of depends on this thing to talk about. But bonds,
Sure.
What are your thoughts on bonds right now?
Well, and one, we always have to remember the connection between a rising interest rate and the price of a bond. So first and foremost is that, first of all, bonds have more value today than they did pre-election, right? Interest rates for a 10-year U.S. Treasury moved from kind of like 1.7%, 2.5% today. You see an awful lot of institutions purchasing 10-year bonds there. So one of the things you'd say with bonds is that you still want to own good government-guaranteed bonds, even though the yields are low, but they're safe. They provide a good rate of return, and quite frankly, they may provide even a little bit of capital gain after a little bit of the move that we've seen in the last, let's call it 4 weeks. Corporate bonds, I think, are still a big part of your portfolio, but I think, the same thing we'll get to with the kind of equity side, I think very domestic bias to it, companies that have a very growth orientation to them, companies that are raising money to kind of meet some of the infrastructure build out that we're talking about and some of the kind of the growth areas of the economy that we're moving towards. I think that still has a great part in people's portfolio as well. And then when we get to the equity side of the equation, still a core holding for people is owning good dividend paying companies. But let's add to a caveat to that. Most Canadian investors are underexposed to growth-oriented names, and in particular, American growth-oriented names. Our indices aren't a great domain for growth companies, whereas the United States typically are, and with this change in policy, could be even better. And then I think with the next step in this is that, for those who are inclined, have the right sophistication level and experience in investing, there are alternatives that I think make an awful lot of sense in an environment where you can buy different type of investments that can help manage volatility. And
there's more from the sounds of it.
And there's more of that coming. So either in itself buying investments that are following a low volatility strategy, or trying to have exposure to portfolios that can be both long and short, or market neutral. So trying to, when markets go down, you've hedged yourself a little bit. And I think that's going to make a lot of sense in the environment going forward.
Brad, always a pleasure. Thanks so much.
No, thank you.
Brad Simpson, Chief Wealth Strategist at TD Wealth.